Hello, this is Tom Kopus with Pring Turner Capital, and welcome to our quarterly video newsletter entitled Volatility Resumes, What's Next? Temporary stock market declines are a normal fact of life for investors. Typically, periodic short-term declines within a cyclic bull market allow the stock market time to catch its breath, reorganize, and re-energize before the primary trend can ultimately take stock prices to new highs. As stated in our April newsletter, we anticipated a temporary market correction and prepared portfolios by taking a more defensive stance. A more defensive stance simply means to take some profits, raise cash levels, and partially hedge portfolios with inverse ETFs. Other protective steps included adding bonds and precious metals companies, which typically have appreciated in value as the overall stock market stumbles. The reality is, this past quarter, we got it wrong. Looking back, we had the right forecast of expected market turbulence, but our tactics did not work out as planned. Instead of helping to dampen portfolio volatility, this time bonds and metal stocks, the typical safe havens, actually led the way with sharp declines. Notwithstanding recent underperformance, we can still report our typical client has achieved new benchmark highs, adjusting for deposits and withdrawals, in 13 of the past very challenging 14 years. What's next? The correction that began in May is likely only partially over. We suspect over the next few weeks there will be additional zigzagging as market leadership shifts take place. This presents the first real opportunity since late last year to add new investment themes to portfolios on any market weakness. Having earlier taken proactive defensive steps in portfolios, we are now in a position to observe and take advantage of any leadership changes. The business cycle is progressing in a normal fashion, and we expect to see a visible shift to favored sectors that usually take place later in the business cycle expansion. At Pring Turner, we define this financial environment as stage 4 of a 6-stage business cycle, which is characterized by leadership coming from energy, materials, industrials, and other sectors of the stock market. A risk management control we utilize in portfolios is to pay careful attention to both the secular, 15 to 25 year, and cyclical, 4 to 5 year, trend for each major asset class, bonds, stocks, and inflation-sensitive securities. Understanding the background environment for each helps us decide what asset allocation is optimal in portfolios while seeking the best balance between both risk and reward. Our book, released last year, Investing in the Second Lost Decade, extensively explored this subject for each asset class. Taking into consideration the fact that stocks recently traded at all-time highs, bond market volatility has increased, and commodity prices have shown weakness, we thought it would be a good idea to review our outlook through these two important time frames. First, bonds started from record high levels of interest rates in 1981 and have appreciated in value for the last 32 years, indeed experiencing the greatest secular bull market for bonds in history. But from recent historic low interest rate levels, we believe another important secular turning point is nearing, if not already past. Bonds have been perceived as a safe haven asset all these years, but recent price action as interest rates spiked higher is challenging that safe haven complacency. For portfolios, our tactics have been to limit exposure to the bond market and emphasize shorter-term, high-yield corporates and floating rate securities. For the stock market, headlines of recent all-time highs are comforting until investors realize prices first approached these levels in the year 2000, now nearly 14 years ago. It's been 14 long years going nowhere. In fact, in inflation-adjusted terms, or real prices, would need to appreciate more than 20% from here to set new inflation-adjusted all-time highs. Secular bear markets end at very low valuation levels. The Shiller price-earnings ratio in the bottom half of the chart shows that stocks are still expensive, and it may take 2 or more business cycles for valuations to reach historic secular lows. We continue to believe the secular bear market for stocks is still in force, but the cyclical advance since 2009 will continue higher. But what about higher interest rates? Stocks can still do well even with rising interest rates, but only for so long. Typically, business cycles and cyclical bull markets end with much higher interest rates and inflation. So while the cyclical bull market is getting long in the tooth, there is still more upside potential ahead for common stocks. Speaking of inflation, commodity prices have been in the news recently, but for a different reason. Prices for some are hitting 2-year lows and put into question the health of the secular bull market in commodities that began in the early 2000s. Our view is the long-term strong period for commodity prices is still in force, but a cyclical decline that began in 2011 may be about to reverse higher. If this business cycle ends like all others, we would expect to see a strong rally in the commodity markets, including energy and metals. Look for these sectors to take over market leadership as the next stock market advance reignites. Investing is a process best described in probabilities. There is no certainty to the future. Over the years, we have managed portfolios through numerous, both good and bad periods. There are times when we can feel pretty smart, and other times where the market humbles us and we don't feel so smart. Nobody has a crystal ball with a perfectly clear view that looks into an always unknown future. Our job as conservative investment managers is to continually weigh the risks versus reward for each asset class and proactively reallocate portfolios. With decades of experience and a carefully thought out investment discipline, Pring Turner has delivered consistent returns while taking less risk than the market. Thank you for your confidence and placing with us the important responsibility of protecting and growing your wealth.